You are eyeing a $2 million private condo upgrade. It is a major milestone, but how does the math hold up in practice? The standard brochure math looks straightforward. You secure a 75% bank loan for $1.5 million, leaving you the remaining 25%, or $500,000, as a down payment. Under this model, hitting a baseline income threshold is assumed enough to clear you for the purchase. Bank eligibility is a formal threshold. It rarely reflects your actual monthly staying power. To calculate your true buying power, you have to look past the top-line numbers and account for hard age limits, unavoidable taxes, and the debt realities that standard online calculators ignore. Let's start with that $500,000 down payment. It is dangerous to treat this as a single, flexible pool of funds. Regulations require that at least 5% of the total property price must be paid in pure liquid cash. That is an immediate $100,000 requirement. Your CPF ordinary account is the standard resource for the remaining $400,000, but there are specific limits on how much you can withdraw for a single property. You cannot assume your entire balance is accessible for this purchase. Then come the expenses that fall entirely outside of your down payment. The first is the buyer's stamp duty. Based on the latest rates for a $2 million home, this mandatory tax instantly drains $69,600 from your reserves. And if this is your second property, you face a 20% additional buyer's stamp duty. Your upfront tax bill just jumped by another $400,000. The true upfront hurdle is significantly higher than the theoretical 25% down payment once you enforce liquid cash minimums and mandatory tax duties. Beyond the upfront capital, your biological age dictates exactly how the bank structures your loan. Most projections assume a 30-year mortgage to maintain that 75% loan-to-value limit. The demographic catch: your age plus loan tenure cannot extend past 65. A 30-year tenure at 75% is only possible if you are 35 or younger. If you are 45, your available tenure is compressed, and your maximum loan-to-value percentage drops. A reduced LTV means the bank extends less capital. You are forced to cover the resulting shortfall with your own upfront cash. Biological age is a hidden financial variable that can drastically inflate your out-of-pocket costs. Once you move past the upfront costs, you have to survive the total debt servicing ratio, or TDSR. This caps your total monthly debt repayments at 55% of your gross monthly income. To afford a $7,161 monthly mortgage, you mathematically require a combined income of $13,020 to stay under that 55% limit. That $13,020 figure assumes zero other debt. Adding car loans or credit cards to the scale drastically spikes your required income. Furthermore, as interest rates scale from 3% to 5%, the mortgage climbs, forcing the required income curve to spike sharply upward to survive. A bank's baseline income requirement is a fragile estimate. It rarely survives the pressure of real-world consumer debt or a shifting interest rate environment. Securing a $2 million property is achievable, but it requires rigorous, customized planning. Before you apply, actively verify your accessible CPF ordinary account limits and proactively clear your existing consumer debts. You must also calculate how your current age will mathematically compress your final loan-to-value limit. Ultimately, sustainable ownership requires a budget that remains perfectly stable and manageable long after that initial bank approval.